Welcome to Markets Now. I'm Michelle Rook with John Heinberg, Total Farm Marketing. We ended Friday with mostly lower closes with the exception of the feeder cattle futures. And John, let's start off talking about the corn market, new contract lows. And of course, the big shock was the increase in yield that we got from USDA, right?
Yeah, that was the surprise. Every USDA report seems to find a couple surprises in it. And, obviously there was two in this one that, really I think came to play. Obviously for the corn side, it was that jump in yield by 2.4 bushels per acre up to 177.3. The market was actually anticipating maybe a small yield reduction, but you kind of did hear that from the countryside. The guys just talking about the amount of corn they got or how things finished out, the surprise of the crop. So deep down inside, I guess I wasn't surprised that we saw that yield jump. It was just a big number. Obviously, that just trickles through the entire balance sheet. And even with some of the demand adjustments, that carryout number jumps higher. And again, that just gives us the feeling of growing supplies. Demand is still a concern here going forward. You got a big Argentina crop coming as the USDA raised that projection. And after the Rosario Grain Exchange raised it to a record 59 million metric ton projection yesterday. It's just a real difficult spot for the corn market right here, as it just feels like we have ample supplies globally as we move further into the spring window.
Plus, we got an increase in the world carryout number by 10 million metric tons?
Yeah, we saw a jump there. Obviously, the U.S. production up, Argentina production up, Brazil with a small reduction. Again, we'll still see how that plays out in the longer term, but the USDA added 11 million metric tons plus to the Chinese production. So that jumped that global carryout or global ending stock number well above expectation when the market was anticipating to see some type of reduction there. So not only do we have higher supplies here in the United States, we're also seeing it globally. And again, just this big supply picture in the face of demand on the global scale just makes it very difficult for prices to find any traction. And obviously that was reflected in the move today.
So, John, we hit those new contract lows. Do you think we have a lot more downside risk in this market?
We're going to be at that spot here now. Where are we at in terms of the domestic market, the cash market, what's happening with the basis, producers moving grain? Those all the pieces are going to start moving in this area. A lot of guys were holding out in terms of they just hopefully got the market to strengthen up. Now we get a technical break. What does that do? I wouldn't be surprised if we just see guys unify and lock the bin doors a little bit longer until they need money for cash flow and have to push some corn out. Technically, though, we broke 460 on the March, closed well under that today. That was kind of a bigger multi-year trend line coming through. We kind of needed to stay above there, at least from the seller standpoint or the technical side. The only thing I did find interesting, we saw the December contract go down to 447. We at least kind of gravitated back to that towards the end of the day today. So maybe that's a kind of a key number that can hold. But right now, the charts look defensive and the supply side looks big, and still could be very difficult for this market to really find some traction. And any price move higher, it's going to probably be met with selling, just as guys need to get things moving here on this cash sale front.
Mm-hmm. Soybeans also shocked, do you think, by the higher yield, or was the market disappointed about the South American production?
I think the higher yield definitely came into that play. We kept talking U.S. carryout, and it's still 280 million bushels isn't a big supply, but it's more than the market was anticipating there. Obviously the South American production, both CONAB this week and the USDA are kind of slow playing that number. We're seeing a wide variety of ranges from private analysts down there. Even had one group come out to a 143 today, but that might be the race to the downside type mentality to make a name for themselves. So we'll see where this comes in here. And so I think it was the U.S. production coming in. I mean, we actually had a really strong crush number for December. So we still have that strong domestic demand, but all of a sudden, hey, we got an extra 35 million bushels out there that we can work with. And the market just wasn't ready for that. And that just made us break technically. Now we'll see if we can hold some of these kind of key levels here. We're down poking at the $12 handle in the March at 12.24, even new crop pushing at the $12 handle. It just feels like right now the sellers are in control of this market, and with the weather improving, at least the sentiment is that way, that it could be difficult for prices to find footing here, at least in the short term.
So the fact that soybeans did hold the $12 mark and at least bounced off of those lows, do you think maybe the most bearish part of the report, or at least the most bearish news, is kind of factored into this market?
It could be at this time frame, but the other thing I'm really watching too, let's look at that export demand. And the last couple of weeks for beans, it's been pretty difficult in terms of the numbers have been coming through. So it just looks like our export window, which was kind of open there because of the weaker South American production, or at least Brazil production, seemed to have slammed shut. You look at the cash market in Brazil, what's happening in terms of their premiums, they are tumbling to multi-year lows and basically making those beans available to the world at a much cheaper level. And the Chinese demand is not there. You look at the big picture. Chinese soybean meal supplies are comfortable. They tried to have a government bean sale, sold nothing on that sale the other day. So it just feels like right now the global bean demand seems to be drying up right at the wrong time as we're starting to get some of those fresh Brazilian beans or South American beans into the pipeline to go with what we already just now forecasted as an increased supply here.
Yeah. How much lower do you think the Brazilian crop is going to get? And, I guess how low does it have to get some price reaction?
I really think the market's probably priced in a 150 type number, 150 a million metric tons. Again, you just kind of look at the chatter that's out there, the comparison to the drought year 2015-16 that Brazil did go with, that things are actually maybe in the worst shape. I think that number needs to probably come sub 150. We'll see down the road, maybe that 145 to 150 window. But again, it's such a hard number to peg because we got such a large production area. You still got areas still planting, you got areas in harvest, plus, second crop beans, how they come into play too. So it's going to be one of those moving targets, I think, for a long time. And we may not know till next year at this window or even in the fall what that number really is.
Over on the wheat, we did get lower winter wheat seedings. We kind of expected that, a little snugger balance sheet in terms of ending stocks by 11 million bushels. Wheat market didn't care. It got drugged down by corn and soybeans.
I would say it was the follower of the day. I mean, you saw the reflected in price with KC wheat or with those lower planted acres only losing a penny or so today. Same thing on the spring wheat side. The tighter balance sheet at least helped out. But it's, wheat and corn seem to be holding hands lately in the marketplace. If wheat's going somewhere, it's kind of pulling corn with. Corn's falling apart, it's pulling wheat with. So I really think that was just the spillover pressure in the entire grain sector overall that just kept wheat from maybe reflecting a little bit more friendly report than maybe the market was anticipating.
No doubt. Cattle market, live cattle futures anyways ended lower. Was that profit taking or some of this weaker cash trade that we saw on Friday?
Cash trade was a little disappointing. Maybe the market was anticipating a little higher trade this week. We were down actually slightly, dollar or two, from last week, maybe tied to the storms coming through the Midwest and, what's going on in that regard. So we may have had a little extra premium into the market going to midweek, and that kind of came out today. And we're still higher on the week overall, with the February contract picking up 80 cents. Over last week. So at least there's still a little bit of a trend. Thing that was encouraging this week, maybe that's due to lower slaughter numbers, things of that nature because of the weather. Saw a nice move in the retail values. Now, if we can maintain that going forward, that would be encouraging. But right now, it still feels like we got quite a bit of cattle we got to work through, and things getting backed up because of weather is not exactly helping in the longer term.
No, long term, though, it should bring those weights down, you would think.
Yeah, obviously with this cold coming into, animals are going to be worried about eating to maintain themselves versus gaining. And, it's going to be one of those things that should help bring those weights down going forward. And then we start looking at the end of the month, cattle on feed, cattle inventory reports. I'm very interested in that cattle inventory report to see where we are in terms of this cow crop, this cow herd and this calf crop.
Yeah. And hogs, just some profit taking there. We did have 6 higher closes in a row.
Yeah, we saw a nice move in the hog market off the lows, but I'm still a little concerned about the market. First off, you look at the fact that we got a cash index trading well below the futures. Maybe we're a little overvalued here. At least saw a little bit of retail strength here today, but the cash market's still my biggest concern. Now the index maybe is turning itself a little bit higher, so we'll have to see if that can continue that trend. But at this time frame, kind of like cattle, we just got to wait. A few too many hogs in the pipeline here, and we'll have to see how that can work through. I do think the weather may be a factor helping out that hog market this week, and we saw some profit taking here on Friday.
Gotcha. We'll close up with crude oil. We're going to have a higher week here, it looks like, but we didn't have the best close today, or at least it doesn't look like we're going to. What happened?
Obviously the issues with the Red Sea and going on in terms of the strikes against the rebel groups over there in the pirates in the Red Sea, fired up the crude oil market. But boy, we just could not get through that $75 handle. A lot of resistance there technically. Again, U.S. is still cranking out a bunch of crude oil at this time frame. That's on the export market. You had Saudi Arabia drop those prices on the global scale with demand concerns this last week as well. So we just threw a little bit of risk premium in. And I think at the end of the week here, the market just felt comfortable taking some of that out going into the weekend just because of the demand is not there. And the supply side, at least, is still fairly strong.
Yeah. And you have a 3-day weekend, so that could have played into it, I would assume. All right. Thanks so much, John Heinberg with Total Farm Marketing. That's Markets Now.